Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Cbre Group Inc. Annual Report. Cbre Group Inc. offers a wide range of businesses and services across various segments. The company's advisory services segment provides strategic advice and execution to clients on leasing, sales, mortgage financing, property management, valuation, and consulting services. In addition to advisory services, Cbre also offers global workplace solutions, which includes facilities management and project management services for clients' occupied space, headquarters, regional offices, data centers, manufacturing facilities, and distribution spaces. This segment provides day-to-day management of client-occupied space, including building consulting, program and project management. The company's real estate investment segment offers investment management services to institutional investors such as pension funds, insurance companies, sovereign wealth funds, foundations, endowments, and other institutional investors. Cbre also provides development services through its Trammell Crow Company and Telford Homes brands for users and investors in commercial real estate. Overall, Cbre Group Inc. offers a comprehensive range of businesses and services that cater to the needs of clients across various segments, including advisory services, global workplace solutions, and real estate investments. The stock price of Cbre Group Inc. has experienced a decline of approximately -5.32% over the past year, with significant drops observed around February 11-12, 2026. One major contributor to this decrease was the company's lower GAAP earnings reported on February 12, 2026. This led to a 13% drop in stock price due to non-cash impacts from the buyout of Cbre's UK pension plan and increased reserves for fire safety remediation. Another factor that contributed to the decline is investor concerns about potential disruption from artificial intelligence, AI. Fears of AI automating office-based tasks led to a 12.5% plunge in Cbre shares on February 12, 2026. This worry stems from the possibility of job losses and reduced demand for office spaces, which could negatively impact property companies like Cbre. The general market also played a role in the decline, with Cbre Group Inc. shares falling 12.4% during trading on February 11, 2026, and experiencing an additional 3.36% drop in midday trading. These factors combined to contribute to the overall decrease in Cbre's stock price over the past year. Cbre Group Inc. market capitalization of $41 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Cbre Group Inc. holds a significant advantage in their industry. Cbre Group Inc. trades at a higher price-to-earnings ratio of 35 times and a higher price-to-book ratio of 4.56 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 62% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets in equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth can be attributed to several key factors. The building operations and experience (BOE) segment saw a significant 14% increase in revenue from 2024 to 2025, while the advisory services segment experienced a 10% growth during the same period. Additionally, the project management segment witnessed a 12% rise in revenue. These increases can be attributed to various factors, such as the acquisition of Pierce and the growth of the advisory services segment across EMEA. On the other hand, there are fewer drivers of revenue decline. Commercial mortgage originations and loan servicing fees declined in 2025, resulting in a decrease in revenue. The United Kingdom revenue also saw a significant drop of 14.9% from 2024 to 2025. However, it is worth noting that no specific drivers were identified for these declines. The growth of the advisory services segment played a crucial role in driving revenue growth across various segments. Its increase in revenue drove growth in both the building services and project experience segments. Overall, the data suggests that strategic acquisitions and geographic expansion contributed to revenue growth, while market fluctuations and regional decline led to revenue decline. The net income of a company underwent significant changes between 2024 and 2025. Initially, it decreased in 2024 due to various economic factors such as slowdowns, recession, fiscal or political uncertainty, market volatility, declining employment levels, and decrease in commercial real estate values. However, the trend reversed in 2025 with an increase of 19.5% from the previous year. This growth was attributed to a 29% rise in operating income. The profit margins also experienced fluctuations during this period. The core EBITDA margin increased to 22.3% in 2025, while the GAAP net income margin rose to 13.4%. However, the operating income margin decreased from 6% to 5.6%. On a positive note, the segment operating profit margin increased significantly from 25.1% to 36.9%. The reasons behind these changes were multifaceted. Economic slowdowns and recession had a negative impact on net income in 2024. However, revenue growth of 14.4% in 2025 contributed positively to the increase in net income. Additionally, higher employee compensation, business promotion, and advertising expenses also played a role in this change. In summary, the net income and profit margins of the company underwent significant changes between 2024 and 2025. While economic factors initially led to a decrease in net income, revenue growth and other factors contributed to an increase in 2025. The profit margins also experienced fluctuations during this period, with some increasing while others decreased. The company's financial performance is a testament to its ability to generate positive operating cash flow. According to the provided data, net cash provided by operating activities has been consistently increasing over the past 3 years. In 2023, the company generated $480 million in net cash from operating activities, which may seem modest compared to subsequent years. However, this figure still indicates a positive operating cash flow, demonstrating the company's ability to generate cash from its core operations. The following 2 years saw significant improvements in operating cash flow. In 2024, the company generated $1,708 million in net cash from operating activities, representing a substantial increase over the previous year. This trend continued into 2025, with the company generating $1,559 million in net cash from operating activities. These figures confirm that the company is indeed generating positive operating cash flow, which is a crucial indicator of its financial health and stability. The consistent growth in operating cash flow over the past 3 years suggests that the company's operations are becoming increasingly efficient and profitable. The company's debt level has undergone significant changes over the past year. The outstanding borrowings under the commercial paper program increased from $175 million to $852 million, a substantial jump of 486%. Additionally, total long-term debt rose by 57% from $3,320 million to $5,181 million, while short-term borrowings skyrocketed by 173% from $906 million to $2.5 billion. These increases indicate a notable rise in the company's debt level. In contrast, interest expenses have shown relatively stable growth. The interest expense for the year ended December 31, 2025 was $490 million, which is slightly higher than the previous year. However, when considering net interest expenses, there has been minimal change, with a 0.5% increase from 2024 to 2025. Furthermore, in one scenario, interest expenses decreased by $22 million due to a hypothetical 100 basis point increase in interest rates. Overall, while there have been some fluctuations, the company's interest expenses have not changed significantly. The financial performance of the company can be summarized into several key segments and regions that performed well or poorly. Segments such as advisory services, building operations and experience, project management, real estate investments, facilities management, and property management all showed strong performances. These segments have been consistently delivering results, contributing significantly to the company's overall revenue. On the other hand, investment management and development services were the only segments that underperformed. Despite efforts to improve, these areas continue to struggle with profitability. In terms of regions, the Americas, including the US, EMEA, United Kingdom, North America, and Middle East all performed well. These regions have been major contributors to the company's growth and revenue. However, Asia-Pacific and India were the only regions that underperformed. The Asia-Pacific region faced challenges due to foreign ownership restrictions, while India struggled with a weak currency. Management is emphasizing the company's strategic focus on providing services on a portfolio-wide basis, pursuing opportunistic development and investment, and co-investing with clients through the REI segment. This approach aims to drive growth and efficiency across various property types. The outlook for the company remains uncertain due to potential litigation, which could have a material adverse effect on financial statements. However, management is confident in the company's strong credit facility with third-party lenders that will mature in 2028, providing a stable source of funding. In terms of segment performance, both the building segment and real estate investments segment have shown significant growth, with revenue and operating profit increasing by 15% and 44%, respectively. Management is committed to continuing stock repurchases using existing cash and has implemented efficiency and cost reduction initiatives that have resulted in costs totaling $259 million in 2024. Overall, the company's strategy appears to be centered on driving growth through opportunistic development and investment, while also prioritizing cost reduction and debt management. The company has made several strategic moves through acquisitions and divestitures in recent years. In terms of acquisitions, the company has purchased Turner & Townsend, J&J Worldwide Services, Direct Line Global, Industrious National Management Company, LLC, Peer Services, LLC, and Relam Amsterdam Holdings BV. These acquisitions are expected to enhance the company's capabilities and expand its market reach. On the other hand, the company has also divested certain assets in order to streamline its operations and focus on core activities. The divestitures include the sale of Altus Power, Inc., shares to a third-party mortgage servicing rights with no specified amount, and sales of real estate to customers. These moves are aimed at optimizing the company's portfolio and improving its overall performance. The company's financial activities have been notable in recent years. One significant development is the share buyback program initiated by the company. In 2025, a substantial number of shares were repurchased, totaling 7,052,481. This move indicates that the company has chosen to invest its resources in buying back existing shares rather than distributing them as dividends to shareholders. The sheer scale of the share buyback is evident from the numbers provided. The total shares purchased in 2025 alone amount to 1,867,318. While this figure may seem modest compared to the overall number of shares repurchased, it underscores the company's commitment to its share buyback strategy. By buying back shares, the company aims to boost shareholder value and potentially influence the stock price. There are valid concerns regarding inventory buildup and supply chain disruption. The issue of supply chain disruption is explicitly highlighted in the report, with a specific mention on page 13. This suggests that there may be potential problems in the management of goods and materials throughout their production, transportation, and delivery to end users. That concludes the financial summary for Cbre Group Inc. Feel free to comment below, and I will be happy to answer them when possible.